Facebook, the Meta company, just announced, and it wasn't the best. It was their first ever decline in revenue. They missed revenue targets and earnings per share targets. So they were expected to do $29 billion in revenue. This is their actual press release from the company. They did $28.8 billion in revenue. Last year, same quarter, they did $29 billion, a decrease of 1%. So that's not good. Now, going down a little bit, total costs and expenses were up 22%. So not only did they bring in less revenue, their expenses went up. Their total profit for income for operations was down 32%. Operating margin was down from 43% down to 29%. Income taxes, let's not worry about that. But EPS, earnings per share, 2.46 per share. They were expected to do $2.56 per share. So what does this mean? Does this mean run for the hills? Not necessarily. Guys, here are some positives to everything. This dying company. Here's the thing I want to focus on first. Headcount. Headcount was 83,553 as of June 30th, an increase of 32% year over year. Guys, they are increasing their headcount to grow more. They want this meta to work. They're putting a lot of money into it. They have warned this is going to be a big cost. Does that mean it's going to work? Not necessarily. In full disclosure, I have a lot of puts on Meta, and I own Meta. I am not going to sit there and talk about how much I own and things like that, but I have puts at much lower prices for Meta. Right now, after hours, let's pull up our software here. Let's pull up Meta, and let's see what the stock is doing after hours. Oh, it's actually rebounded back to even. It was down to 160 at one point. Tim, can you confirm that? It was down to 160 after hours when they first announced. Now it's even. Now, I like seeing this being even. Why is that? Well, at some point, there's just not enough sellers out there. I don't think we're there yet with Meta. I think there's a lot more selling to go on here. That's why I'm selling puts at lower prices. But you have to look, is that accurate? Tim is confirming it's accurate. So I look at all of this and think, okay, what does this mean? Well, if you're new to this channel, I'm Paul. I'm a value investor. My goal is to look at a long-term perspective and not worry about the quarter-to-quarter results. I think about my businesses upstairs. I have 8 or 9 businesses upstairs. Everybody always asks me, Paul, when are you going public? I will probably never go public, and here is why. I believe in investing in the future. I believe in sacrificing profit today for the future. Sometimes that's good, sometimes that's bad. In Facebook's case, in Meta's case, it could be a very good thing. Doesn't mean it's going to work out, but it could be a very good thing. They're putting a lot of money into this metaverse. They changed their freaking name to Meta Company. They want to make sure that they are known as the company that owns the metaverse. They still have Instagram. Some other big things I want to show you. Daily active people, 2.88 billion on average. That's an increase of 4%. Monthly active people, increase of 4%. Facebook daily active users, 3% increase. Facebook monthly active users, 1% increase year over year. So we are seeing some increases in people's usage. Now, one big concern, ad impressions and prices per ad were decreased 14% year over year. So the fact that they were still able to get almost the same revenue as last year with a 14% decrease year over year, kind of impressive. Now, could that be me looking at the icing on the cake and saying, oh, look, this is fine? Very well could be. We all have biases. I'm trying to be aware of mine. But again, my goal is to look at this company from a long-term perspective and see what I think is going to happen if I buy it at the right price. So let's use our stock analyzer tool. Let's use our software to go through the 8 pillars and determine what we're going to look for in Meta. So I'm going to go to our stock search. And by the way, if you're a subscriber to our community and our software, please follow along. So look at this big drop in Meta over the last year. 384 high, 154 low. Currently at 168 and change, 167.80. All right. First pillar, we want the 5-year PE being below 22.5. It's 17.83. Guys, one thing I want to tell you, we're going to do a lot of math here. If you don't have our software and if you're new to the channel, there is a shortcut to all the math at the end, but I want to show you our entire process because I'm very big on disclosing my process and having people learn how to fish as opposed to me giving them fish, okay? Pillar number 2, we want the 5-year return on invested capital greater than 9%. So back on the main page here, same place, 16.3%. Now, no dividend, And here, their 5-year average free cash flow is $24 billion, 1-year free cash flow of $40 billion. This does not include results from this quarter, but that'll be in the system here in the next few days once our software updates from our provider. Pillar number 3, very simple. We want revenue growth of the last 5 years. So we go to our income statement and we look. 5 years ago, 43.88. Last year, 120 billion. Now, their revenue last quarter was about 29 billion. So they're pretty much on pace for the same revenue continuing on. All right. Pillar number 4, very simple. Net income growth. We just want net income growth over the last 5 years. So we scroll down a little bit. 5 years ago, 17.86. Last year, 37.34. It doubled. So again, great, good story. Look at this. 10 years ago, it was $67 million. They make that in a day now. Is that accurate? No, they make that in like freaking less than a day. All right. So pillar number 5. Now, this one is an important one that if you're new to the channel, you're probably hearing it for the first time. We want shares outstanding staying the same or decreasing. What that means is the company's buying back its shares and giving a higher piece of the pie to you. They're now splitting the revenue and profit amongst less owners when they're buying back shares. You keep the number of shares you have the same, but now the number of shares outstanding is less, so you own a bigger piece of the company. So we go back to the end of the 6th year, 2.89 billion to 2.73, check mark there. Now, one thing I want to bring this back to is look at their press release. It's announced right here. Share repurchases. We repurchased $5 billion of our Class A common stock in the second quarter, and we have $24 billion available and authorized for further repurchases. So they're planning on buying back $24 billion worth of stock. Now, what's the company? The company is, the market cap is $461 billion. That's exactly 5% of the company they're going to buy back. You're now going to own 5% more of the company just by having shares after they buy back the shares. Okay? That's an important part. Now, pillar number 6 has to do with debt. Debt works the same way with a company that does for you. We want to make sure they have manageable debt. So we've come up with a metric. We take their 5-year average free cash flow, 24.3. We multiply it by 5. That's $121.5 billion. Okay? So $121.5 billion. We want to make sure their long-term liabilities are under $121.5 billion. So we go to the balance sheet. We scroll to the bottom. Guys, look at this. $20 billion. In fact, their total liabilities are 41, but their long-term is 19.9. You want to get even crazier? Their total liabilities are 41 billion. That means everything they owe to everybody, short-term, long-term. Look how much cash they have on hand. $60 billion. They can write a check tomorrow and get rid of all their debt and still have $20 billion left over. This company ain't going under. It would take a lot for this company to go under. That is a safe proposition. And remember, in successful investing, it's about managing your downside risk, not your upside risk. When you avoid the big falls and the bankruptcies, you're more likely to do well. Pillars 7 and 8 have to do with free cash flow. So we go to our cash flow statement. Remember, guys, free cash flow is cash from operations less your capital expenditures. On our software, we put it right below here. This is nowhere else where it's written. It's not on a cash flow statement normally. You can do 5 things with free cash flow. Buy back shares, pay dividends, reinvest back in yourself, pay down debt, and make acquisitions. Those are the 5 things you can do. You can do any 5, all of them, less none of them, any combination. So 5 years ago, first metric was their growth. 18.74 to 39.8. That's a check mark there. Our final metric is we want to use the free cash flow over the last 5 years to get some sort of value for the company, like the PE ratio. So we take 24.3 and we multiply it by 22.5. In that case, we get 480 and 480 and 48 is 528 and 12, $540 billion. We want the market cap under 540 billion. If you remember from the main page, it's 460, I believe. So that's a check mark there. So let's go. I told you there was a shortcut here. Let's go here to show you the 8 pillars. It's all 8 check marks. Now, does this mean you go buy the company? Not necessarily. This is a good sign, but if the prospects for the future aren't good, you might necessarily want to buy them. So what we did was we created a stock analyzer tool. What that does is it allows you to take your assumptions. We don't know the future. And every investment is the present value of all future cash flow. We have 1,700 videos, and I've probably said that sentence 8,000 times in those 1,700 videos. You take those assumptions you make in the future, and the stock analyzer tool will tell you based on those assumptions what you should pay for the stock today based on all of that. So let's go to the stock analyzer tool. It's been the most popular thing on our software. If you like the software, what you've seen so far, check out everythingmoney.com or patreon.com/everythingmoney to sign up. It's super easy. It's less than a cup of coffee per day. And there are literally people in there who said it changed their lives, and a lot of people. So join the 13,000 who've already signed up. So guys, look at this. In the last 10 years, they did 40.8% a year in revenue growth. And in the last year's same quarter this year, they had a 1% decline. So this revenue growth is not going to be possible for long periods of time. But I also don't think they're going to be declining a ton, even though they are warning for things ahead. So let's assume 2, and I'm going really conservative here. Let's go 3, 6, and 9% revenue growth. For profit margin, let's go with 29, 31. Let's go 28, 30, and 32. Free cash flow, same thing. I'm going to do the exact same thing. PE, I'm going to do 14, 16, 18, and same with the free cash flow. For my desired annual return, I'm going to do 12.5%. Now, the stock's currently at 167 after hours. Once I hit the analyze button, it's going to take all this data and churn it out and give me a price to pay for the stock, not including the balance sheet, etc. And remember, they'll be green, they'll be red. If it's all green, does it mean you go out and buy? Again, you want to make sure that you understand the story of the company and that your assumptions here are correct. Join our community. You'll be able to talk to people about Meta because I guarantee people are talking about Meta as we speak. There are 10 messages in here right now just for me. I'm sure a couple of them probably said, did you see Meta reported? So we hit the analyze button. Boom. So a low of 148, a high of 300, a middle price of 211. So if you're part of our software and you want to be a little more conservative, add it to your watch list at 148. It'll notify you. Guys, thanks very much for watching this video. Please watch other videos we have, and don't forget to subscribe to our channel and share this video. Thank you.